Hey everybody! Thanks for tuning in to Minds of MOT Finance. Sorry, MOT Finance, MOT Crypto. We're here with Malcolm Reese, my co-host on the show, and we are going to be talking about a few things tonight. There's a lot of different topics, but before we jump into those topics, let's just wait for some people to come on in for the YouTube and the Twitter. So everybody that's on Wisdom, if you guys want to hop over on YouTube as well, that would be awesome. I think we both have links in our bio.
Yes.
That would be awesome. The more likes, the more follows, and comments in the YouTube will definitely help us.
With a better reach and of course, reaching audiences of a diverse audience diversification helps tremendously.
Right.
Today's going to be a jam-packed episode. I'm excited. I got a lot of things to talk about, and you do as well. So it's going to be quite interesting.
Yeah, man. It really is. And there's a lot going on right now, especially in the world. I mean, just in the world, as everybody knows. I mean, there's the whole thing going on in Russia and Ukraine. There's the supply chain issues. There are things going on in the crypto world, finance world, and it's not all just bad. There's a lot of good stuff too. So, we're ready to get this thing going. So, Malcolm, why don't you start us off, man? Talk about what you're going to talk about in regards to the markets, what's going on, your insights.
All right, so I'll do just a brief breakdown of the market indexes and how they perform throughout the week, and then I will delve into a few terms here that would be useful for the context of what it is that we are going to be talking about on today's episode. So with that being said, so the markets, all three of the major indices performed diligently as far as a brief uptrend. There definitely was a little bit of resistance. And when it came Thursday this week, actually Wednesday, when the Federal Reserve decided to finally implement one of their first of many interest rate hikes, which is going to definitely, in a short amount of time, definitely alter the way in which certain commodities are trending and certain assets as well. But overall, the Dow Jones Industrial Average closed at 0.80%. Positive, of course, the S&P 500 index, consisting of a lot of tech-oriented companies. That's more specifically the NASDAQ. But the S&P 500 index closed at a 1.17%, which is very, very good, collecting those minor losses. And in addition to the NASDAQ index, tech-heavy NASDAQ, a lot of tech industries in there, closed at a surprisingly 2.05% to end the week. So a lot of these indexes definitely were undergoing a lot of consolidation due to the continued uncertainty in the United States market indexes, or overall global markets as well, especially considering what's happening in politics with with the Biden administration making some leeway in trying to get these oil imports or find other ways to bring more oil imports into the domestic territory, being the sanctions that a lot of adversaries and countries initiated as a response to the Russia-Ukraine crisis. So the indexes overall performed pretty diligently. I'm interested to see how they perform next week, considering that will take in full effect of how the economy is choosing to respond to these rising interest rates, and of course the existential societal issues of what you just mentioned earlier. So other than that, we are going to define a few terms here. And I think it's important to define some terms in regards to what it is that we'll be talking about. So that way we can at least keep attention there, or at least have that there for reference. So we're going to be talking about mortgage-backed securities in this episode. And mortgage-backed security is basically backed securities. The acronym for mortgage-backed securities is MBS. And basically they're bonds that are secured by home and other real estate loans. So the purpose of mortgage-backed securities is to allow central banks and local banks to act as an intermediary. An intermediary is basically like an adjudicator or perhaps a middleman. So these mortgage-backed securities allow banks to act as middlemen, like a regulatory system, between home buyers and, of course, the investment industry. And it's imperative that the mortgage-backed security maintain stability and fluidity as well as it continues through its course. But that will definitely be altered, but that'll be talked about a little later. So mortgage-backed securities basically helps with providing liquidity to institutions. And that's a good thing to know in the context of what it is that we'll be talking about.
Really quick.
Is the Fed's fund rate. Yes, the Fed's fund rate is what I said. So the federal funds rate is an interest rate that banks change so they can borrow or lend excess reserves overnight. So the law requires that banks must have a minimum reserve level in a proportion of their deposits. And this reserve requirement is held at a Federal Reserve Bank. When a bank when a bank has excess reserve requirements, there can be a little bit of friction, which could lead to funds overnight that may be stalled in certain circumstances, especially in the presence of the pandemic, which is what resorted in this kind of overflow of liquidity. But we'll touch on that briefly. But long story short, the Fed funds rate is an interest rate that banks charge each other for the transactions, because the way banks work is not only do they make money off of the deposits that you execute into these accounts, trading that money and doubling that, which is why it takes time for these transactions to be processed, but they also rely on trading money amongst one another between financial systems, and amongst one of those facilitators is the Fed's fund rate. That's just describing the fundamental aspect in which banks talk to each other in terms of sending each other money. Now, the FDIC, I know in certain cases it's self-explanatory, but I'm just going to touch on it. The FDIC is the Federal Deposit Insurance Corporation, and it is an independent federal agency insuring deposits in the U.S. banks and, of course, thrifts in the event of bank failures. So it's basically insurance, all right? So the FDIC is another institution that regulates and insuring accounts. Usually joint accounts are secured up to $500,000, whereas single accounts are FDIC secured up to $250,000 as far as losses could accrue. So that's basically insurance or liability for banks as well. So that helps banks and it helps you, obviously. You have the Treasury note. Now, and this is the fourth term. The Treasury note is, and they call it T-note for sure. Whenever you see it in the market news, T-note, it helps. So T-note is a marketable U.S. government debt security. And the way that I describe a security, I personally think of it as a safe asset. So whenever you hear security, think of it as a safe asset, or perhaps an underlying asset of any sort. That's just how I draw that association. So it's a debt security with a fixed interest rate and a maturity between 2, 3, 5, 7, and even 10 years. So there's different variations. And I'll say that again. It's a fixed interest rate with a maturity that varies between 2, 3, 5, 7, and 10 as far as maturity date goes. Now, the only difference that separates these is simply the length of maturity. Now, T-notes are on the market, of course, seen as popular investments. Additionally, Treasury notes, bonds, and bills are all types of investments in debt issued by a bank or perhaps the U.S. Treasury. Now, to delve even further with the Treasury notes, there is a little bit of risk associated with Treasury notes. Treasury notes is based on maturity as well. So the higher a T-note's exposure to interest rate risks is, and basically more, the higher probability you will accrue any volatility, especially in times like this. And in addition to that, credit strength, a note or bond's value is determined by its sensitivity and changes to interest rates, which is the premise of this specific discussion because of how imperative it is to understand the importance of interest rates, of course, and how it can affect you. So with T-notes, there's risk, but investors are willing to take the risk with T-notes, considering that it's more gradual, and of course, it's a debt security. So it's a way in which people try to, hedge against any losses that they could potentially accrue. But it's not foolproof, of course. As you can see, they're very sensitive to a lot of parameters of macroeconomics. Likewise, a rising yield indicates falling demand. Okay, so maybe I should have prefaced with this. So because they're very sensitive to interest, one thing to understand is that there is yield associated with these treasury notes. So with a rising yield, there's falling demand. With a lowering yield or a decreasing yield, there is more demand. So when you see the treasury note and you hear about the treasury note online or in market news saying that the yield is rising on the treasury note, there is falling demand for those treasury notes. But if you're hearing that the yield is low, that means that there is rising demand and people are going to buy into it and, of course, be opportunists and take advantage of those low yields. People love those yields, but it's always good to get in when you can. So with
why is it really quick? Why is it that the yields change based on demand?
Can you say that one more time? Are you speaking from
why are the yields why do the yields change based on demand?
The yields change based on demand from several different parameters. So when you factor in what these banks are doing as far as yield goes and the interest rate associated with these bonds and these debt securities, the debt securities will determine, and the interest and the yield on these debt securities will determine their value. And if they don't have any value, then of course it'll fluctuate. But if there is value within these yields or within these debt securities, then of course there is something to get within it. And right now, a lot of people are trying to hold as much money as they can, considering the volatility in the market. So it's like people are trying to find any way necessary to avoid any kind of loss. And these treasury notes, it gives a tentative reference on the overall outlook of these yields, or perhaps the 1-year treasury note will give you a tentative outlook on the bond market, in addition to these debt security assets. And when you also factor in, let me think here, what is it called? Indexes, of course, as well. Treasury note helps out tremendously. So with a certificate of deposit as well, because this also plays into role. Certificate of deposit is a time deposit, a financial product basically commonly sold by banks, thrift institutions, and credit unions. Certificate deposits differ from savings accounts in that the certificate deposit is a specific fixed term and usually fixed. It's at a usually fixed interest rate. I'm trying to formulate words here. Give me
So really quick.
Yeah, go ahead.
The yield comes from the interest rate that the Fed sets. Is that right?
The yield. Say again.
Where does the yield come from? What determines the yield? Is it the interest rate?
What determines the yield is the amount of volume and the amount of volatility. And if let's say that commodities are rising right now. Commodities are pretty hot right now in the market. And when you have rising commodities, you have, as a result, the ramifications of how that can impact the treasury note. Because if you have a rise in commodities and there's a scarcity of demand, then of course you have demand pull inflation as well. So inflation is another variable that plays in the fluctuations of this yield. And when you have inflation, you have these banks that have to adjust to that inflation. So now that impacts the annual yield on these particular debt assets, which is another thing about the mortgage-backed securities and why the Federal Reserve is reducing the amount of liquidity into market by reversing their program into purchasing debt assets. So that's allowing a lot less liquidity into the economy, which in the first place that triggered it was to provide liquidity in the economy because of the pandemic, because of the fact that these businesses were going to struggle, because of the fact that there was going to be a scarcity of resources for these businesses to continue normal operations due to the supply constraints and, of course, the global tensions that are now rising based on with everything that's happening. So in a lump sum, because I'm not a financial advisor, and I probably should say that, I should have prefaced with that. And in a lump sum of information, due to the limited information that I have and what I'm learning, because I'm learning just as everyone else is that there is a plethora of variables that affect the yield on these debt securities. And a lot of them deals with the scarcity of resources and, of course, how much these banks are making in a potential recessionary period. But that also, once again, is dependent on macroeconomics.
So do the interest rates play a role in these yields at all when the Fed decides the interest rates have to increase or decrease?
Do the interest rates play a role in the fluctuations of these assets? Is that what you're asking?
the yield. I guess I'm not really understanding it.
That's fine. That's okay. It's understandable. The yield is
So
what you
how does
make
this
as a
tie
result
into?
of
So how does this tie
the
into
asset that you're
interest
buying.
rates?
The yield is what you make as a result of the security that you're
Yes.
buying.
How does this
The
tie into interest rates? That's where I'm getting confused.
Oh, the yield will decrease because as these interest rates rise, they become less valuable.
So where does it get its value from?
The central banks, mortgage-backed securities,
So where
purchasing
do
of the real estate
where do
sector, flowing of money into the economy, liquidity, providing more liquidity into the economy, less liquidity into the economy. So there's quite a number of variables at play.
so how do mortgage-backed securities have value?
Mortgage-backed securities have value because the Federal Reserve gives them value because they're purchasing it in such a large quantity. When you have a huge institution that's buying something at such a huge quantity, of course it'll drive up value, but they're doing it simply at the expense of preserving longevity because they want longevity. So they acquire all these assets in hopes that they won't fluctuate out of order, that they won't fluctuate out of place. So that way, when it's time to finally lower interest or higher or reduce liquidity into the economy, as a result, there is going to be yield increase. I'm sorry, there's going to be yield decrease, but the interest rate will increase. Okay, so as interest rates increase, yield will decrease. But as interest rates decrease, yield will increase. So if it is not valuable, that asset will lose on interest. But there
So
is
it
yield.
seems so the value is just determined by where the Fed wants to pump its money.
Yeah, even though they pump over last year they pumped over I think over $100 billion in assets, if I'm correct. So a lot of this deals with this will hopefully with everything that I have written here, it will definitely satisfy your inquiry because it's all literally connected based off of everything that's happening as far
Yeah,
as
well,
inflation.
you're doing like an information dump, so it's trying to you're trying to connect a lot of different dots here, and I think it's kind of difficult to do.
It is difficult. It was difficult for me.
So
It's still difficult for me, which is why I'm trying. Like I'm trying to make sure that I at least define the terms, so that way when I delve in and you hear a term associated with what I defined earlier, that way you will be able to follow what it is that I'm talking about. Because I know for a fact that what I wrote, some people may get lost or deterred. That's why I feel as though this disparity, this just dispersing this information about these terms is essential. But I see that you do have more questions about these terms with and of themselves. And a lot of it is just, in the simplest way that I can describe it, value driven. So
and the
because we have,
value comes from the Fed deciding where it wants the value to be.
yeah, and the central banks are basically the facilitators in this process. So when you have the Fed giving these central banks an excess amount of money as a response to the COVID-19 pandemic, because these banks were experiencing minor difficulties with all these charge off and of course these other constraints as well that basically held up a lot of these assets, making it almost, well, not just making it more difficult for them to do their work. That created a lot of friction. So as a cushion, the Federal Reserve provided these central banks more money as a form of pandemic relief. So that way they can continue to trade and make money and hedge against these inflationary pressures, these supply constraints, all the money that they were expected to use with all these charge-off balances and these delinquent accounts. We actually touched on this, I think, wow, like 6 episodes ago. In regards to how the Federal Reserve plays a role when it comes to the central banks, and then how the central banks play a role in how money is dispersed throughout the economy. And that actually is going to be more expanded in the last topic that I have here, with what I want to talk about, with how you're going to be losing money if you have an interest savings bank account, because these banks don't really care about rising the interest on these accounts, simply because these banks are always going to make money off of your money. and they're not going to worry about your money making money simply because that money doesn't serve as much value as a hedge against the inflationary pressures. Plus, if you really want to think about it, these banks are technically hedging against inflation with using the money that you give these banks to deposit with trading over these periods of days. But with that being said, are certificates of deposits useful? Certificates of deposit are useful for people looking for a way to save money with earning a relatively high interest. So you always want to make interest off your assets, and a way to make interest off of the assets that you invest in could be a certificate of deposit. But in crypto, I believe it's a stake.
What's the inflation rate right now, they say?
The inflation rate for yields, for bonds, for the treasury, for...
No, just the CPI.
Oh, it was 7.8 at one point, but it's now 7.9%.
And how much interest does a CD provide you?
A CD provides you, I don't know, actually. I don't know.
All right.
I've never really invested in and looked further into a certificate of deposit because that's not my niche.
How much does a CD interest rate give?
But the thing that you do make...
Well, right here. So basically, with a CD currently, for a 5-year CD of $10,000, you're going to get an average AP. You're going to get an APY of not even 1%, of 0.8%. So why put your money in a CD? Let me just show why put your money in a CD if CPI, which isn't entirely accurate. And I'm not challenging you on this. I'm just expressing something here. Like, let's look at this, because this is how messed up our system is, right? So we're finding out that the value comes from where the Fed decides where the value is. From what Malcolm is explaining, value is derived from the Federal Reserve, and the central banks decide where that value is going to go, from what Malcolm's saying. And the Fed also determines what the interest rates are. You don't have a say in the interest rates. And then the interest rates, and those interest rates will affect your yields. Okay, so right here, a CD, for example, a $10,000 deposit in a 5-year CD with 0.8. But what is the average? Let's see.
I don't think you can quantify an average because they fluctuate. These rates fluctuate on a constant basis.
You can do an average on how much Bitcoin earns every year, and there's a huge fluctuation in Bitcoin's price. So let's look up the average APY of
another thing to factor into as far as APY and APR goes and just yield goes is the maturity as well on these certificates of deposit.
Right here. Sorry, but it's right here. So it looks like the average rate for 1-year CD is 0.14%. 1 year. Then you get 5 years, the average is 0.27%. So not even a percent. What's a high? What do they consider high? High APY is 0.85. But at the CPI, which isn't even a correct measure of inflation, is 7.9. Why would you get a CD? I'm just asking everybody here. Why would you get a CD? You're losing money.
You're still making interest.
You're losing money though to inflation, because inflation's 7.9. You're getting outpaced by inflation. 7.
Yeah, and that's another thing about certificate deposits too, is that yes, they all have a maturity date. So a maturity date is a date in which the life of a transaction or financial instrument ends. So it will really the interest, the rising in any form of fluctuation of interest on these certificate deposits will be altered simply because you have these fluctuations in interest rates. So it'll also affect what you make when that asset finally matures. So you could easily you could invest in a certificate deposit, and as interest rates or as inflation continues to expand and grow, these certificate deposits may lose their value. So I guess you're right. You're definitely right in saying that it is outpacing inflation, but it's another asset or security that you can use to save and make interest off of.
But not right now. Not right now. It's not a smart move to do right now. And in a hyperinflationary period, it's not. So what should people? So in the traditional markets, I think what would be of most value in the traditional markets. What's offering APY that'll outpace inflation?
Say again. I'm listening to you on my phone, so I have to.
You're good. What's offering APY that will outpace inflation?
You said what is offering APY?
Finance. Yeah, what has an APY of over 7.9% in traditional finance?
I don't know. I don't think I've seen anything that has an APY. I mean, the bonds don't even have a good APY. Certificates of deposits, another form of debt, another debt instrument. I mean, at 7.9, no, I don't think there's anything viable that has of such high value as far as APY goes. But
so I know this isn't financial advice.
If there's interest involved, that yield will be altered, though. The amount of yield that you make off of that particular asset will be altered if these interest rates continue to climb.
Yeah, but have you seen it? So, but what's the possibility of the APY eventually catching up with the inflation?
The API of these assets?
Of what we're talking about here.
Yeah, no, I was just there's a lot of assets. So when you narrow it down, I can give you a better worded answer. So the AP, what's the likelihood of what? Of reaching 7.9? You said. I was just trying to understand.
So you're saying that the yield is changed based on the interest rates?
Yeah, its value is changed based on the
interest rates go down, APY or your yield will go up, right?
Yes.
Okay. So if interest rates keep going down and the APY keeps going up, but inflation at the same time keeps going up, what's the probability of any APY reaching the inflation?
Doesn't seem like a likely it doesn't seem like a good likelihood. That's a very, very interesting question to ask,
and
considering that there's stagnant growth in the economy.
Right. So if it's not likely, what would you do then, since we can't give financial advice, to actually hedge against inflation? Because right now, if we're actually being realistic, we have not discovered in this conversation one thing that'll offer anybody a hedge against inflation. Everything that can be offered right now is going to actually lose them money.
Well, we didn't really get into the topic of discussion. All we did was define a few terms here.
Yeah, no, I know. I'm just cutting to the meat. So it's like, what would you do, Malcolm, in the traditional market? What is your play to say inflation, at least the CPI, which, by the way, guys, inflation is much higher than the CPI. But from the CPI, 7.9, what are you doing? What are you doing to outpace it? So that way you're not losing money to inflation.
The thing that's going to happen inevitably is unless you're invested in something that generates ridiculous yield like Hex or a few other coins out there in crypto, you're always going to be, if you want me to get real philosophical, I feel as though a lot of us humans, since the inception of the banking system and so on and so forth, have been hedging against this constant inflation that's been happening ever since its inception. And a way in which people have found a way to get a leg up or in advance is either having the money to use to make more money and generate revenue off of that revenue and reallocating it to assets that will continue to grow and adjusting their portfolios accordingly, or nowadays getting into crypto. And I will not deny that the yield has been pretty rewarding on crypto, but that will actually tie directly into one of the topics that I have here as well. So that's how I knew this conversation was, this was going to be a great episode because there's a lot of great things to talk about here. But ultimately, to answer your question, because I don't believe I did, I don't think there is anything tangible that you could use to outpace the current inflation. Because here's the thing: you're going to have these facilities, these stores, these institutions that are going to drive up the price on the cost basis of these assets or these commodities based off of either the scarcity or perhaps trying to adjust to inflationary pressures, the wage pressures, the labor force pressures as well. These all of these expenses that are incorporated in making sure that you're sustaining normal operations and making what you would hope to make, or at least try to mitigate any form of loss as far as your quarterly earnings go. But I feel as though a lot of these companies, a lot of businesses right now are definitely going to have some really interesting quarterly reports coming up in regards to how they maneuvered or are trying to maneuver through this kind of interesting issue that we're facing right now with inflation.
So would volatility then be a hedge against inflation? Because if you can't do it on APY, if it's hard to find in traditional markets in the APY, well, then a volatile stock that can go up a lot then has the potential to, it's risky, but then it offers the potential for you to combat inflation.
Well, here's the thing, is if you invest into a volatile stock, what goes up must come down. So the question is if you get on one short squeeze ride, yeah, you'll make your money off of that volatility, but is it enough for sustainability, longevity? Because inflation will always happen. It's just a byproduct of macroeconomics. So will you actually hedge against it from a volatile stock? I don't believe so. I don't think you'll hedge against it because you'll have its run.
It's a byproduct of the monetary.
If you're actively hedging against something, you're fighting on it. You're hedging against it on a constant basis as it changes throughout society, as society continues to advance. And I feel like if you invest in a volatile stock, which is a one-time and only thing, I mean, are you really hedging against it every single day? I don't believe so.
Well, I just want to add something here that inflation is actually a result of the MMT. It's not based on the macroeconomics, yes, but the macroeconomics that we function off of is the monetary or the modern monetary theory, where essentially we can just print as much money as possible and make as much debt as possible and just keep it going in perpetuity. But then that creates inflation. And so I just wanted to add that there, that it's not naturally inherent in macroeconomics. It's only a result of a debt-based system.
And what's the system in which it functions through? What's the foundation? The foundation is through macro. I mean, that's the process of macroeconomics.
Macroeconomics is a framework. It's not the principle. The principle is debt. The principle is debt to money print. So if you can print money, you need to have debt. So debt generates money. That's where money comes from in our system.
I see where you're getting at.
And so then therefore inflation is coming from the money printing. And so so there's more debt, and then there's more money printing, but then there's more debt. And so then there's more money printing, and then inflation continues in perpetuity. And that's modern monetary theory.
And as interest rates continue to rise, and as you have inflation, well, interest rates fluctuate, but one thing that's always going to remain consistent, of course, is the debt to asset ratio, debt to monetary ratio, and of course you have this inflation. Inflation is one of few things that will always remain consistent as far as society continues to exist. But it's becoming more.
That's not true. That's only for a debt-based economy. That's only for a debt-based economy. Literally, that's only for a debt-based economy.
It doesn't. That inflation is consistent.
Yeah, the inflation is because of a debt-based economy.
Well, then we've been in debt since
we have
since 1774. Then, if that's the case,
yeah, we've been in debt ever since there's been a Federal Reserve, ever since there's been central banking.
So then you're also providing substance to what it was that I was saying then, because it's a debt-based economy, right?
The economies that we've lived in have been debt-based, and that is not the only kind of economy there is.
Well, of course. I mean, there's affluent economies, but they function based off of the imports and exports. And of course, like you have labor force, you have employment, you have sustainability as far as the flow and income goes from these countries. And of course, whatever they decide behind closed doors as far as how they can make money. I mean, obviously, commodities is amongst one of them, which is exactly one of the reasons as to why we're in the situation we're in right now. But in theory, with what I was saying is that because we have inflation, which, by the way, the Federal Reserve plans on implementing 11 interest rate hikes. Well, 17. Whoever said 1776, the United States Constitution was drafted in 1774 and in 1774 by the Continental Congress. So it wasn't we weren't declared as independent until 1776, but there were tons of meetings by the Continental Congress that led to its date of inception, thus giving us the independence. I know you're fact checking me. Anyways, with what I'm saying is that as you have inflation that is consistent, especially in today's society, it's becoming more obvious that it's hard for the average American to keep up with inflation, because as you adjust these interest rates and you have inflation that is consistent, another variable to consider, especially when it comes to making sure that a country works, because a country's driving force is its labor force, especially in America, especially in China. And if you have a labor force, but you have stagnant unemployment and you have stagnant labor force growth, which is what we've been subject to lately, no thanks to the pandemic, that's creating a lot of friction as far as pressures go when it comes to these goods and services that are provided. And I know you're going to say localize your supply chain, your local supply chain or food chain, which is essential. But for the average American that isn't localizing their their supply chain, it's becoming increasingly difficult to try to mitigate your finances accordingly, or allocate your finances accordingly, as you have these rising gas prices, the things that you once used to purchase at places like Walmart becoming slightly more expensive. These other, you have Netflix, Hulu, and a few other streaming platforms soon to come that are going to be rising their rates for the services that you're purchasing through them as well. Inflationary pressure, also a few other things, but that's not today's story. But long story short, it's becoming increasingly difficult for the average American to adapt to the inflationary pressures that our economy is facing right now, which is creating more pressure as far as trying to push out an initiative for more green energy and several other solutions that these central banks are trying to come up with. And that's where I will transition into talking about one of the first topics that I have here is the post-pandemic and the Fed. Post-pandemic, the Federal Reserve is taking back what they gave in an attempt to stabilize the American economy, which I hope will satisfy any questions that you have that's brewing in your head. In the beginning of 2020, when the life-altering COVID-19 pandemic arrived.
Whoa. Did you just say the C word? We're on YouTube. We're on YouTube. It's the unicorn here. We call it unicorn. We don't call it by its real name.
Call what?
What? CVID, dude. Whatever that vid thing is.
Oh, I didn't know. I don't.
Anyway, keep rolling. Unicorn.
Okay, unicorn. Got it. In the beginning of 2020, when the life-altering circumstances, or CVID, pandemic arrived in the U.S., the result was a rise in unemployment, a crippled labor force, adverse supply constraints, unhappy institutional investors, disrupted financial markets, and much, much more. As a response to this unprecedented chain of events, the Federal Reserve stepped in to increase the volume of liquidity flowing into the economy with the expectation of mitigating the damage done by the pandemic. Likewise, a few notable actions by the Federal Reserve consisted of encouraging banks, both small and big, to tap into their regulatory capital and liquidity buffers in an attempt to increase lending for borrowers like you and I to have during the pandemic. Of course, you're familiar with the pandemic relief package that was passed along, and of course, several other stimuluses that came along with that as well. That was amongst a few other things that the central banks did as an attempt to alleviate what was going on, though it didn't help at all. Now, this included large purchases of U.S. government and mortgage-backed securities, in addition to lending money to support households and employers. The Federal Reserve's urgency to intervene became abundantly clear when the extreme volatility broke out in the traditional and bond markets, as well as a disarray that was unfolding in state and local governments as far as to how funding can go for programs, local programs, school programs, of course, and you have these private and public businesses as well that were also going through a little bit of confusion as well. And that created a little bit of a chain of issues along the way, as you had other issues like these trucker delays and shipment delays as well. But that's interesting. Fast forward 3 years to Wednesday, March 16th, 2022, which was 2 days ago. The Federal Reserve has began to reverse this exact program by providing liquidity into the economy by implementing their first of many interest rate hikes. And by lifting the federal funds rate, which, as we mentioned, is a debt asset, by a quarter of
there's a lot of info right there. So let's summarize that really quick. So Fed was stimulating the economy by giving people money directly, right?
Yes.
And now they're trying to slow the stimulation down by raising interest rates.
Yeah, that's what I wanted to tell you about when you were talking about like the constant inflation, and it's hard to kind of beat the interest rate, the fluctuation in interest rates. And the way that I've learned so far is the way the Federal Reserve tries to provide stability in an economy is by putting money into it and taking it out when it's not necessary, when they believe it was necessary. They were actually, from what I read, but it could be wrong, planning to implement it a lot sooner. But I believe I believe what's going on globally is probably what caused a little bit of reluctance there. Actually, I lied. They actually implemented these interest rate hike, the first interest rate hike, sooner than they expected to, because they wanted to actually do it in the summer of this year. So they implemented it early at a 0.25% basis point, instead of it being a 0.50% basis point. And you were about to ask a question?
So the Fed basically is trying to control the economy.
Well, that's how they control macroeconomics. I mean, that's how money is flown through the economy to create stability. And that's why I personally believe as though inflation will be something that will remain consistent in an economy. That is, unless the United States stock market just implodes.
What if we go back on a gold standard? Then would inflation exist? So think if we tied it up to actual. That's not my question, though. We're talking about inflation.
I know.
Crypto is predicated on this failed system, but it allows people to sort of decentralize the Federal Reserve, because you get to choose where you're pumping liquidity into.
Yeah, you're right. You, the person, the retail investor, does have the opportunity to decide, and the free will, where you're putting your money.
So basically, we don't really have a free market, right? There, in a macro level, there is no free market because the Federal Reserve has a lot of say in what happens in the economy, who gets money, when they get money, what the interest rates are, right?
And it's a board of directors that basically establishes the total expenses within.
Who picks these board of directors?
People that are in very influential positions, and of course, financial analysts like Jerome Powell.
Let's see who. So, do we actually know who elects them?
I don't know what the process entails.
Reserve Chairman. Let's see. So, the Banking Act of 1935 changed the name of the Federal Reserve to the Board of Governors of the Federal Reserve System. The governor. Okay. Let's see. Because this is important stuff. So basically what we're learning today from Malcolm is that the Federal Reserve essentially acts as it plays God for the economy, essentially.
Well, they have other institutions that help facilitate this process. It's not all. It's not primarily.
Yeah, God has angels. God has angels, right? He can send messengers. So you can make the analogy that the central banks are the Federal Reserve's angels. This sounds very weird that I'm using these analogies, but they kind of work. So let's see, who elects the Federal Reserve Board? Most often, a board of governors is elected by shareholders of a company or upper management of an institution. Wow. So the people who are determining how the economy run are those who own or have major shares in corporations. So you don't get to say how the economy's run. There are people way higher than all of us, and they determine when the government gets money, because the Federal Reserve is not even federal, right? The Federal Reserve is not owned by the federal government, nor is it a reserve of any currency. It just makes money, makes currency rather, and then it determines who gets that currency. And the people who determine who get that currency are elected by people who tend to hold the most of that currency.
You and I both know that, though, unless there's some kind of an outlier. Like, obviously, money and wields influence. It wields influence, and of course, if you have enough influence, you have the influence to make a decision at the better interest of what you believe, you feel like the way you want to shape the world. So yes, and in essence, these people that have these very, very very high positions of influence, I guess you can say, are making these decisions on the betterment of what they think the economy should be or reflect at. But you also have regulatory institutions as well that play a role in determining whether or not it's say so. And of course, I would like to believe that amongst that board of directors is a non-biased party outside of that also helps with facilitating these
you
decisions.
would like to believe it, but is it the actual case? Because these institutions are the ones deciding who's in position. So why would they have somebody in that position that would go against him?
Yeah.
And so these people, the whole point I'm making here with this little rant is these people who are controlling the economy are elected by other people who have a lot of money. And so they're going to do what's best for them. And so where do these people put their money? What do these people do to hedge against inflation? Do we know that?
I think because they know that they're making the decisions, that one would only assume that they reduce their shares and then buy more back. It's like I guess you could equate it to insider trading. I mean, if you're the one that makes the decision, then you'd probably be the exact same person that would withdraw your money, wait for it to settle down, and then put more money back into it to make more money from that money. So you're generating yourself more wealth because of your position of influence. I mean, that's just my theory. But
yeah, so it's called.
Want to say that you have 7 minutes left on the timer. So when you do get the chance, definitely hop back out and hop back in as well.
Yeah. So let's there's actually a term for what I was just describing there. What do they do to hedge against inflation? How do these people work out that? Right? How do they do that? Well, it's actually called the Quintillion Effect. The Cotillion Effect. All right, now you may be asking yourself, what the heck is the Cotillion Effect? Well, I'm trying to find a good demographic. Let's see. Let's see if I can find something. So basically, in essence, I was trying to find something that summarizes it concisely. But the best way to explain it is the Quintillion Effect basically means those closest to the money printer get the money first.
That's basically what I theorize.
Yeah, it is, and it's called the Quintillion Effect. And a lot of people, like Warren Buffett, have benefited from the Quintillion Effect. A lot of very wealthy people who may not be very smart. You got to think about this too. Just because you're in these positions don't mean you're that intelligent. Doesn't mean that you're that smart. And just because they're close, and this is important. A lesson here is that be careful who you have close to you. You want to be cautious of that, and you want to have the right people around you, because we can dog the Cantillian Effect all we want, but it's the economy we live in. It is what it is. And these are just truths that I wanted to bring to the surface in regards to these topics, because Malcolm is providing a lot of good information. But at its essence, what are these things? What are these things, and what do they do, and how do they get their value? How does the Fed work? Who elects the Fed? Have you ever thought of these questions? Have you ever thought of the Quintillion? I mean, Malcolm has just now thought of the Quintillion Effect, but a lot of people are unaware that there's even a term for it, that there's even a thing on how people.
Are you sure you're not looking at an Urban Dictionary definition?
I mean, you can look into it some more, man. It's a real thing.
I mean, no, I mean, I'm not knocking the word, not the principle behind it, but I don't doubt it. Like, I do sometimes think to myself, like, and I've questioned that before too, like, how are these people that are at the top able to sustain being at the top? And then I just thought logic, and I feel as though the hardest questions that we ask have the most simplest of answers. I guess the only way people that have the kind of influence to stay in wealth is to know the direction in which money is headed. If you know that based off of the fact that you have a unicorn approaching your alleyway, well, you would take the necessary precautions and talk to all the people that are in your little inner hub and circle of financial information and wealth and insight on the strategies.
Oh my God, are we talking about a conspiracy theory, Malcolm?
Yeah, I know. I'm just saying, I wouldn't doubt it that there's like a select group of very influential people that come together and they strategize their financial strategies on what they're going to do next, what they're going to buy, and how they're going to react in accordance to the economy to, in a sense, hinder the growth of the economy, or perhaps manipulate to the economy to the extent in which it's difficult to try to find any sustainability unless you're obviously someone that's in that position to have sustainability and the all-knowingness in terms of where money is headed. So, yeah, I mean, it's definitely a theory that I've opened my mind to. So,
and then I'm going to be this guy. Why would you want to be on top of a house of cards? Because if the value is derived from the belief, because it's quite literally the belief of the Fed, then it's based off of nothing.
That's why crypto, with and of itself, I think is to some people in Congress, a foreign asset that to them brings no value, but to people that have been involved in it for quite some time, obviously there is value in it. And I think I talked about this quite some time, like the fact that we, or these people that are in these very high positions, give things like mortgage-backed securities, bonds, and of course these other things. It's like, okay, imagine it like this. Here's a better way I can phrase it now. Playing Monopoly and having infinite money. It's literally like going to a printer and printing the monopoly money that you have so you can have infinite money to print, to flood into the economy. It's having an abundance resource of money. So if you think about it, these people that are in these positions are literally the richest of the richest, right? And I'm sure that there's an undisclosed list of people that are richer than people that they choose to say that are the richest people on this earth. It wouldn't surprise me. So with that being said, it's just difficult. It's frustrating to know that our economy is being manipulated at the expense of people that clearly want to continue this uncertainty in our economy. And I think it's important to understand financial literacy so you know how you can at least try. I don't think you can accomplish it unless you're extremely rich, unless you know something that I don't. Please tell me, to hedge against things like inflation and interest rates, of course. But we deviated severely. But before we continue, I do need you to hop back into the wisdom.
Yeah, you can keep going. You can keep going. I got my eye on it.
Roger. Okay, so with what I was talking about, with the fact that the Fed is taking back what they gave in the attempt to stabilize the American economy, you have the fact that since they have the ability to make such waves of influence when it comes to monetary value, the value of that particular asset, that obviously has consequences. And consequently, the interest rate market, to be sure, is pricing about 10 hikes. As I mentioned, it might be 11, but I think it's 10 because I'm reading various sources. So it's a lot. Anyways, it's still quite a lot. and it still can be something that would drag down economic growth. And I did say this actually on one episode. I can't help but feel as though they're deliberately sabotaging our economy. Like, if you don't factor in the global tensions that we're facing right now, we still would have been trying to recover from the pandemic. Like, yes, the labor market would have recovered, and it is recovering slowly but gradually. But you still have these obvious supply constraints, which I'm still trying to figure out why it is taking so much effort and resources to try to get this back on track. But I keep reminding myself, labor market, labor is a driving force of American continuity, or of financial continuity within flow of revenue in the United States. And of course,
what are you trying to figure out? I'm sorry.
Domestic goods. No, I was just
supply chain?
I'm just trying to figure out why there still are like supply chain constraints, given the nature of our economy.
Well, I think it has a lot to do with the fact that we see the Eastern powers taking over. The West is no longer in control. We see this now with the fact that Saudi Arabia is considering taking the digital yuan over the USD for oil, which then would destroy the petrodollar, which in effect would destroy the USD, or at least take it from its top spot. And then you have trade routes being changed, right? Like there's a theory that China is doing lockdowns simply to drive out Western business, and then they keep everything within their country because they do all the manufacturing anyway. And
but
so a lot of what's
that's stupid. These lockdowns are going to halt production.
Yeah, global economy. You're thinking of global economy, but it's not going to halt their internal production. It's not going to halt what they do. It's going to halt what we get. And so it's constraining the West. So in effect, what we're seeing is a sanction, from what I think, a de facto sanction, because it's not official, but it's a de facto sanction on Western countries and Eastern powers such as Russia. Yeah. I don't know if it's collateral. I think it's intended damage.
Yeah. So mutually assured destruction.
No, I think that China is just going. I think China, Russia, and India are going to overtake the trade. People are going to want to go to China, India, and Russia for trade. Primarily, China will be number one. India, probably number two. Russia, number three. I don't know how it's really going to work out, but I'm pretty sure China will be number one. They're already starting their own digital payment system as well. Now we're going off into a little something different, but as far as supply chains go, that's what's happening. We are seeing the revival of the Silk Road, and we're seeing the destruction of the of their sea trading, of the merchant trade, of their sea trading that took place.
And see, I'm sorry. Go ahead.
Yeah, so I think that's why we're seeing supply chain issues, is because the West, specifically the United States, has been so dependent on globalization. We've outsourced everything. We don't have anything in-source. And so that's why we have an issue. That's why we have supply chain issues, which is why I keep saying the key to this is localizing supply chains, reviving those supply chains.
Yeah, and I actually did read an article. I can't completely paraphrase it, but it's along lines of what you just mentioned, and that's going to be another attribution to the rising. It's going to be another attribution to inflation, because as you have these prices that are now, because I feel you can't tell me that there's not going to be any stipulations to these trade agreements that these adversaries or these countries have amongst one another, and if from what I read and what you explained, is also is going to be put into fruition, that's going to create pressures as far as supply and the prices for supply and demand go, as far as these global trades. So now these shipments are going to be more expensive, which in this case means that not only local businesses are going to have to pay more for the supplies needed to sustain business operations, but now driven by that is the fact that they're going to charge more for the goods that they provide, for the services that they provide. But think about it on a grander scope of things. Now these businesses are going to have to factor more on a monthly expense basis, based off of the fact that when you have a supply constraint of having to pay more for a product that you have shipped for your business in America, that there is going to be a price associated with that, and a price increase associated with that is what they call demand pull inflation. Isn't it beautiful? It's like a whole domino effect of inflation. If this costs more, well, we're going to charge more for this. If that costs more, well, we're going to charge more for that service. And it's simple as that. But the question is because the Federal Reserve plans on implementing at least 10 interest rate hikes, most of which I would only hope are going to be 0.25% basis points, how is that going to affect market longevity, like global market longevity? Because yes, you can say that the people at the top are going to be perfectly fine and they will remain unaffected. But to the demographic of people that are trying to hedge against this, how can you expect us to hedge against a society that's literally that's literally climbing before we can even try to adjust? This adjust period is going to be quite difficult. Like I am adjusting and I can afford the expenses that I have in my life, but it's still like now it's becoming, in my personal opinion, a slight inconvenience, because I'm very like analytical. So like I factor in my monthly expenses and how much I plan to spend on this, that, the third, and the other, and I index it. But now I find myself having to deviate away from my monthly expenditure by changing and altering that simply because the things around me are costing more to acquire. So now I'm adjusting my monthly expenses, thus adjusting my my annual expenses. And then in addition to that, how can I prep for this as these interest rate hikes continue to will persist, because the economy will adjust in accordance to these rate hikes. So now I have to adjust each and every time these interest rate hikes hit. But it's a separate issue, but it is an issue nonetheless. And I'm sure people are also dealing with this kind of thing. And the simplest way that I can equate it is just the things that you normally buy, like perhaps a box of cereal, now $2.39 from what once used to be $1.45. And that's all factored into the GDP, the gross domestic product, which basically classifies how the value of a specific product, but it doesn't factor in the prices. It doesn't factor in the variables it takes for that product to be built, but it factors in the overall value of that product. So like, let's say to build a Lego, I don't know, let's say to build this, it's a separate price to build this as opposed to the case. But because the price driven for this is increasing because of certain components, let's say a semiconductor, right? That's going to cost a little bit more. Now that within of itself will drive up the price of the overall basketed good. So a basketed good is a single item, a complete item. This is technically a complete item, despite the fact that it comes apart. But now,
so what you're saying is the supply chain issue is causing the prices to go higher.
Well, I mean,
it plays a huge role.
Well, they're accompanying it, yeah. They accompany the issues that we're facing right now, but the people that set the prices are the people that obviously distribute those goods from those facilities. So now, let's say you have an item that you sell at Walmart, right? It's in the as seen on TV aisle because you're famous. Being the inflationary pressures, of course, you will adjust, because you're going to start noticing that you're losing more money than anything, because you're trying to hedge against the inflationary pressures, the fact that as prices for assets or commodities or even just tangible things are raising, well, your product is losing value because you're implementing the same amount of money it would take to produce that product that you put into Walmart stores. So now that's production costs, in addition to the shipping costs as well associated to get that product delivered to the stores. So now those shipping costs increase. And when you have those shipping costs increase, well, I believe there's also the costs that are distributed depending on the amount of time that item spends on a shelf at the store. But that's a whole nother variable that I haven't taken the time to study just yet. But long story short, if you don't adjust the price of that particular product that you're selling at the store, but you're still paying the same amount of money as you would, if not more, to produce that item, then you're losing money on that product, technically speaking.
Right. So one way, a long-term play to combat against this rise of prices, is to, beating a dead horse, but localize the supply chain. Because then you don't have to depend on this global structure, right? And then something else here to think about, if inflation is real, which it is real, right? That means there's more money in circulation. So if there's more money in circulation, that means there's more money for you to get.
And what was that effect that you had mentioned earlier?
I'm sorry?
What was that effect, that term that you used to describe how the rich, what we described earlier?
It's called the Quintillion Effect.
Do you think that could also play a role? Is that if we can continuously find a way to hedge against it, that we're also playing into the Cotillion Effect?
I don't understand.
Sorry. So what I'm saying is because this alleged Quintillion Effect is playing a role as to how people are always finding ways to stay on top of things because they know the direction and flow of money. Wouldn't you kind of assume that if you're also trying to find a way to adjust to the flow of money as well, so you can mitigate any kind of losses accrued as inflation continues to rise, the Cotillion Effect, wouldn't you attribute that to it? It was just a brief hypothetical question.
Well, no, the Quintillion Effect just means the people closest to the money get the money, get most of the money, get the money.
But like, can't you get close to the money if you get lucky on an investment as well, like with crypto?
Yeah, but we're talking way different though. Like Quintillion Effect is like being somebody like Warren Buffett. We're not Warren Buffett's.
Man, my eyes keep watering.
We don't know Jerome Powell personally. We don't have a relationship with him. Quintillion Effect are for those people who have relationships with the people who print the money directly. And so as far as what I'm saying, you're never going to be able to get the kind of money that the people that are close to the money printer get because they're the ones making the money. But my point being, one solution, localized supply chains. The other solution is to find the money. Go find the money. It's really that simple. What can you do to go find the money?
Is there like bleach on this freaking rag or something? My eye keeps killing me here. I don't know what's going on.
Oh man, you good?
Yeah, I'm good. I think I'm good. But yeah, so with that being the question, let's talk about oil and energy sectors right now in the market. Oil and energy sectors are not getting the same kind of attention that they once had a week ago. And I can personally advocate on behalf of that, considering that I lost quite a lot on the stock on CEI. That was interesting. If Mick, if you're watching, you understand. I
what is CEI?
CEI it's just an energy it's an energy asset on the stock market, publicly traded. So CEI is an energy commodity that fluctuated because of on February 24th when Russia invaded Ukraine. Of course, a lot of energy. That's actually going to be what I talk about in here. So with that being said, on Thursday, February 24, 2022, Russia conducted what its president described as a military operation to invade the borders of the Ukraine with the sole objective of conquering Kiev, which, as defined, is the capital and most populous city of the Ukraine. And being that the case, this unprecedented event briefly benefited the oil and energy sectors in the global and domestic markets. So after the sanctions were imposed on Russian oil imports by surrounding adversaries and countries, included in the NATO community, of course, that also drove up the price, or that drove up demand. And I'm speaking on behalf of domestic relations. So I'm talking about the U.S. markets that drove up demand for oil. As you saw at one point, the price of oil per barrel for the Brent crude, the Brent benchmark was, I think last week, about $127 a barrel. It's the highest I've seen it. And then now I recently saw that it was yesterday, it was at 98. No, 2 days ago, it was at $98 per barrel. And then I checked the day after, so yesterday, and I saw that it was at $102 per barrel. So it's already getting past $100 per barrel. And as I mentioned in the other episode, if the price per barrel for oil, for producing oil, increases, so will these gas prices, of course, as well. So the expectation before CVID or unicorn was to have at least $70 per barrel as a distribution that would have kept gas prices at an economical discount, and that's what economists were expecting as a result, or post unicorn. But that didn't go that way. It went the opposite direction, in fact. And now we are literally talking to Iran saying, hey, everyone else said no. So, how about we, try to factor out an agreement of, more oil imports. So right now, the United States is in talks with Iran in negotiating a deal for increased oil imports, which in hopes to produce over $1 million a day, a million barrels, a day, which is likely, but we'll see. And if that does happen, these domestic oil companies may subtly rise in value depending on the percentage. But as a stipulation to that agreement, that deal is that they will have to forfeit some kind of nuclear arms deal or something along the lines of that. I didn't read too far into it, but that's just what's on the talk right now. That's not my niche here. Okay. So with that being said, when you factor in the lack of progress in peace talks between Ukraine and Russia, along with the U.S. negotiating a deal with Iran on oil imports, one can only assume that this is one of few reasons that explains why prices for oil and energy retreated from their highs last week, because they definitely did. I learned a valuable lesson. And I'll tell it to the audience, it was a momentum play. And I looked at the oil and energy sector, but I didn't think any further into it because anything in that index and that sector would have made you money. And it made me money, but I kind of lost the money that I made with the. Anyways, long story short, I tried to seek an opportunity through investing in the oil and energy sector, and it didn't pan out as I expected because, unbeknownst to me, they were retreating at the expense of talks with Iran. So that eased investors' nerves, thinking that despite the ban on Russian imports, which I know it's going to seem contradictory, so let me try to make sure that I'm following myself here. Despite the fact that we issued sanctions on oil imports from Russia, which at the time we were receiving 10%, well, between 8 and 10% of those imports from Russia, as it is the second largest oil producer globally, that made the prices of domestic oil companies or energy companies go up. And as a response to that, these domestic industries either filed a 10K or they filed a 10K or a 1K. So basically, well, I don't think anyone went public, but a 10K on the stock market is basically saying, hey, we're getting businesses back up and running in the simplest way that I can describe it, and we want to announce this to our investors. So there's different kinds of filings on when you look at a stock on the market. I won't narrow that, but I'll probably put it in a separate episode. And with that being said, that gave an opportunity for these domestic oil companies to see what they can do as far as potential goes. And some of them actually will be starting production from what it seems. But I thought an opportunity like that to invest in that sector and was completely mistaken and learned a valuable lesson. And I probably should look further into the company's financials. But that's on me. And it's fine. You win, you lose. And I know you're going to say this, Luis, sometime in this episode, but best way to invest is, the best way to make money is to invest. And I'm not going to deny that. I won't deny it at all. my statements are looking pretty nasty for this tax season. So with that being said, this brief retreat in these domestic oil companies that shot up resulted in a lot of retail investors and traders becoming discouraged after losing money on the oil and energy momentum plays that pan out so well. So the way I think about it, and this is just how bad thing as far as future market sentiment for energy is concerned, because the Energy Information Administration, EIA, which acts as a data analysis arm of the U.S. Department of Energy, they actually recently released a report on Wednesday that predicted oil prices would average $113 a barrel for the month of March and $112 per barrel for the second quarter. This can strongly suggest that oil prices won't stay low for much longer. Obviously, they haven't. Anyways, for consumers, this is unwelcoming. Obviously, no one wants to hear the price per barrel increasing, thus gas prices increasing as well. Nobody wants to hear that. But for domestic energy producers, this is an opportunity to be brought back to life. And when you consider that the International Energy Agency also released a monthly report that pointed out a large decline in Russian oil production, which, by the way, would be bullish for domestic oil. The world produces about over 100 million barrels of oil, and a shortfall of 3 million barrels would make a major difference in prices. So basically, us issuing sanctions on Russian oil imports made us have to work harder domestically as far as oil imports go, or as far as oil production is concerned as well. So that's also an attribution as to why these prices are still going up as well.
And didn't Joe Biden want to halt our oil production? Isn't that what the Biden administration wanted to do initially?
Well, that's not what they made public, but one can assume or theorize that that's what they're doing. But what they're publicly saying is that they're tapping into their oil reserves.
No, I'm talking about initially into the administration. The goal is to switch over to green energy. And so you would have to get rid of oil, correct? And so the Biden administration wanted to get rid of oil. They wanted to make it harder for oil production.
Yes, that was definitely the initiative with Biden's Build Back Better Act that unfortunately did not pass through Congress, which resulted in so now, since you're talking about that, I mean, I'm not going to downplay the future outcome of that happening, considering that the Biden administration still does want to be to try to do something in regards to that. And as they're constantly as they're tackling that right now, the biggest issue is obviously, well, one of the biggest issues is the labor force. We need people to work so we can reduce production costs. That way, we can also handle those prices or reduce those prices. But that would also, in this case, result in us tapping into these oil reserves that we have. At the time, it was over 600 million barrels. I don't know how many are in there now. I don't know. I truly don't know. But if we produce on an annual basis over 100 million barrels of oil, one can only assume that that oil is going to run out. So if the Biden administration plans on, as they've articulated, breaking up the Build Back Better Act, which in certain provisions of that Build Back Better Act allow for, that favors in rule of energy companies, green energy companies specifically, then that would be a more presumable reality or a more realistic reality. But as of right now, it seems like the government is kind of stagnant in terms of their decision making because their attention is obviously focused elsewhere. For which I guess I can understand, but it still is something to question, undoubtedly. So we will see how that pans out.
So where are we getting our oil from?
I mean, we're getting our oil from these domestic oil producers. I would only assume that we still have relations with exterior global entities that allow us to also have oil processes going. I mean,
you didn't hear that Joe Biden, the United States rather, is in talks again with Venezuela and potentially Iran.
I thought that Venezuelan deal didn't go through. I thought that they basically shut the door on him.
They could, yeah. I think you're right, but this is a recipe for disaster, is it not? I mean, we're shutting off we're shutting off oil from Russia because we're framing them as the bad guy. And then we, under the Trump administration, sanction the living hell out of Venezuela and try to implement a new government. And then we go back to Venezuela and say, hey, we want to do a deal. And then if I'm not mistaken, there's potential without deals with Iran.
Yeah, and that brings into question too, what are the stipulations of these agreements that we're making with these foreign entities? Because I would only assume that part of a negotiation involves making a sacrifice, and I'm just curious to see what would be some of the sacrifices or the ramifications of deciding to allow oil imports from Iran. I'm just interested. And Venezuela. I'm just interested. I'm very interested. So with that being the case, comparatively, the same exact report from the EIA, which once again is the sorry, I'm trying to get the flow going here. The EIA, which in this case is the Energy Information Administration, the report also indicated that there was a drop in demand of about a million barrels a day. So when you factor in that you're seeing a lack of demand, I mean, these prices might decrease, which, as we've previously discussed, is that what is that? Deflation. Deflation. That's the deflation we're hoping for. Because here's a likely outcome that I've forecasted in my head. As gas prices continue to soar, people will be less likely to, or will try to not have to use gasoline vehicles if they don't need to, or to drive if they don't need to, or overall they're going to try to reduce their expenses when it comes to paying for gas prices. Or if they're used to filling up their tank, probably might do half a tank and try to mentally convince themselves that they're paying less for gas when they're still paying the same amount. It's just different variations. But the point is that I theorize that as gas prices soar, consumers won't buy it as often or buy it as much as they're accustomed to, or try to find an alternative to hedge against that, i.e. EVs, or i.e. working from home and not having to do anything. As last year's jobs report, 13% of jobs accounted for that of remote, and remote jobs are becoming prominent as well. So if you have people that work from home, in addition to people that obviously don't have to worry about gas because they drive EVs, then let's factor out those two variables right there. And when you think about the ramifications, long-term ramifications, which actually would work in the benefit of the economy based off of what we discussed earlier with the Federal Reserve putting liquidity in the economy in hopes to help it recover or keep it from imploding, and then taking that money back out when they think that they're in the clear at the expense of rising interest rates to keep that down so that it doesn't continue to go out of hand. One would only assume that with gas prices or commodities that it works in a similar fashion at the expense of the consumers and their wallets. Now, when you have consumer expenditure, and as reported in the CPI, which is not completely accurate, one of the biggest expenses for consumers was energy. So now you have, and commodities, and of course, energy is it's a category in the CPI, but and it quantifies what I'm talking about. But when you have that and people spending a lot of their money, that will also reflect, I would say, probably 3 months from now. I would say, honestly, 4 months from now, you're going to see some really interesting stats on the CPI and the GDP. But other than that, though, I just think personally that as a result of people not wanting to buy gas as often, gas prices will eventually begin to dwindle gradually, because since the demand is not there anymore, or there's not as much demand for that particular asset or commodity or anything that you wish to describe it as, there's not demand there, then by proxy, the price for it will decrease. It's like having a popular toy in Walmart versus a non-popular or a knockoff brand of that, and it's cheaper. Well, that's a terrible analogy, but what I mean is that the price will eventually decrease. But I personally don't think that kind of deflation won't take place until, I'd say, honestly, about maybe 3-4 months, when people really start feeling the short-term ramifications of forfeiting more money for gasoline. Because right now it's an inconvenience, but eventually it will be a hindering factor for some. That's just that's one of my forecasts is what I assume, especially as gas prices raise. I mean, highest gas price I've seen was $4 and 4.2. It's gonna be great when I move to California, because I saw all the gas prices out there, and let's just say I'm glad that I work from home. So with that being said, the issue with what we're trying to tackle right now as far as inflationary pressures go, there's a lot of uncertainty in the direction in which interest rates could go, considering that you have inflation that is, as of right now, very consistent. And when you have an overtly emotional market right now, that's extremely it's hanging on the threads of volatility. Like literally, the Nasdaq and the S&P 500 have entered correction territory at least twice this year. If that's not an indication of the government trying to put money into or flood money into the market to prevent an implode or perhaps a faster than expected bearish trend. Because if you look at the chart right now, if you were to look at the year-to-date chart, actually, no, the 5-year chart of the indexes, you're going to see some really interesting squeaky lines that go up like this and down like that and a little bit like that and up. And then now you see a little bit of that curving. And I saw that and I was like, 5 years from now, yeah, I don't think that's it. I don't think that's the move. So we'll see exactly how that pans out. But a lot of investors are emotional right now for literally everything that I explained so far. It's just the market is extremely volatile. And I feel as though with crypto transitioning into that, that's one of many ways that you can hedge against your insecurities of financial longevity. But it's important to study these trends. It's important. And I personally believe it's important to become familiar with just the simple principles of macroeconomics, or just understand how interest rate works, or how mortgage works as well, or how a car loan works. Actually, you know what? That's actually going to tie directly into this next discussion here. Okay. So with that being said, you should be very weary of the fact that these entities are trying to bring more oil imports, but it's kind of one of those things where you kind of have to wait and see. So that's that. Because right now I feel like in the market, anything could change in a dime. I mean, it has so far. I mean, Federal Reserve has already adjusted their point basis rate hikes, and they're probably going to do it again per the question that Mick asked in the MOT group chat. I wouldn't doubt it. Okay, so the next topic here is, what do rising interest rates mean for you? Well, I'm going to go and do a brief list, and then I'll expand on them. For starters, rising interest rates on future and existing mortgages will be apparent. You'll have interest rates on new car loans that will rise. You have the APR, the annual percentage rate increase on future and existing credit cards or on any form of unsecured debt. That will also increase.
And unsecured debt?
I'm glad you asked. So unsecured debt is different from federal debt. So let's say student loans. So student loans is not unsecured debt, because that's not money being loaned from, that's not money that you're borrowing from a lender. That's money that you're borrowing from the government. Now, when you're borrowing unsecured debt, that's basically a loan that you're taking out through a third-party banking institution of any sort, like those quick, fast, easy loans. That's unsecured debt. So that's money you're taking from a bank. If you apply for a loan, that's unsecured. Secured debt, of course, is federal debt, like student loans and mortgage-backed securities. But so with that being said, with unsecured debt, and that's one of the things that right now a lot of people, a lot of things that I've been reading on, people are trying to tackle, is that unsecured debt. Because if they're paying on interest on a monthly basis, unless it's a fixed interest rate, if it's not fixed interest rate, then that bad boy could go out of hand if you don't pay it down fast in time. So that's kind of essentials. If you're in debt, probably should find a way to not be in debt. I know it's easier said than done, but that's the simplest way I can phrase it. So another thing that interest rates will go up with is interest in bank accounts, if any, will remain unchanged, which means that the money you're saving in a savings account is losing value and is not a good hedge against inflation. We previously we touched on that briefly in the beginning of this episode, but that's one of the ramifications of these rising interest rates that people should be wary of. That's why I've actually started slowly but surely rotating my money into into crypto. I don't want to rotate it all because I still want to have money to play with. As previously mentioned, the Federal Reserve has finally raised its short-term benchmark rate by 1/4 of a percentage point on Wednesday. So that 0.25%. That happened this Wednesday. And that's, of course, something that we have to deal with now. So now, delving further into the brief bullet points that I made about how interest rates will affect you, with talking about mortgages, and these are just brief points here. I won't expand too much on this because these are all separate conversations within them of themselves. So rising rates mean that home buyers and owners will pay a little more each month in mortgage payments. So your house is financed through a bank. That bank, and what this means is that you being the borrower and the bank being the lender of that loan for you to finance that house or that mortgage means that there are obviously stipulations. Well, the stipulation being that you're paying on a monthly basis on interest. Of course, that's interest that you're paying on for ownership of that property or vacancy. And with that being said, not vacancy, but like ownership. But with that being said, is that you're with these rising interest rates, you're going to find yourself, unless you refinance your mortgage, you're going to find yourself forfeiting more money on a monthly basis towards your mortgage. And with that being the case, when interest rates go up or down, the resulting changes in other rates impact the way we borrow money. So what I mean in saying that is there's going to be other things, and this is just universally speaking, this is not even in accordance to mortgage, but obviously this is going to change the way, and as I mentioned, how you do your finances when you have to start finally like going over your monthly expenses and your expenditure. That's amongst your mortgage, if you have one, is going to be one of the expenses that you have to go back to the drawing board or perhaps start sacrificing more money at the expense for. So now the things that once used to bring you pleasure and joy, you might have to get one less cup of Dunkin' or Starbucks a day. Oh Lord, man, I'm having fun here. Anyways, so with that being said, long story short, with mortgages and rising interest rates, you're going to notice that the bank that you're financing your house through will have an increased interest rate. I don't know when that will take an effect. Every different banks work very differently. So when it will take an effect, I think you probably should ask your banking institution when exactly that can take an effect, so that way you can at least get ahead of that and tackle it while it happens. And with that being said, and this is one thing I'm learning still as well. So I'm figuring this out day by day because I definitely want to get into real estate, especially virtual real estate. I'm learning that the way mortgage prices are set is based largely on the yield of the 10-year government bond. This is touching on what we discussed briefly earlier. So basically, prices for mortgage prices are established based on the amount, based off of what's made on the 10-year U.S. government bond. So there's these, once again, those mortgage-backed securities. Depending on the amount of yield that they make, will determine, I guess, from what I'm learning, the prices set for these mortgages. And I guess they reference the U.S. Treasury as well as a tentative reference on how they can adjust accordingly as far as interest is concerned, despite inflation. Like, I'm not even talking about inflation. This is just interest. So, and this is actually crazy too. This rate is used as a benchmark for all different types of loans, including mortgages, including auto loans, and that of including unsecured debt as well. It's a universal benchmark. And as of January, and this is something I got from an article I read, as of January, the median sales price of a single-family home stood at $357,000, $357,100, which is up nearly 16% year over year, according to the National Association of Realtors. So
real estate is beating inflation.
Yeah. Well, it is for now. For now, I say that because. And this, I'll draw on another theory. As you have these interest rates increasing on these mortgages, because another ramification of these rising interest rates is that it's not only going to impact people that have existing mortgages, but it's also going to impact the demographic of people that are seeking a mortgage as well. Because these banks are going to offer at higher APRs. And yes, creditworthiness is a variable to consider, but it's not a complete determination on whether you'll get a competitive rate. Because now you'll have these banks that will try to establish which bank has the most competitive rate and who can offer a competitive APR, but that's besides the point. So what I mean to say is that despite how lucrative real estate is right now and how there's so much liquidity within real estate, when consumers start to become less attracted to these interest rates or less compelled to want to buy a house with a very high APR, they're probably going to be dissuaded. And there was actually another thing that I read. Oh, crap, I didn't include it in here, but I'll paraphrase.
What about commercial real estate, though?
Well, then you'd have to buy. So if it's commercial real estate, then you're buying land. And the question about that is, will the land continue to build on revenue, or will it continue to build on value? Like, will there be any ROI on that land, especially if it's in a community that's not as affluent? And I guess there's another parameters about that with the city as well. So I'm not going to doubt that it will, that commercial real estate will help with this, but I personally feel as though like all of it will be impacted, but not so heavily as it would impact like a private real estate as opposed to like real estate, as you said, with commercial real estate. But you obviously want the commercial real estate that you're invested in with the land that you're invested in as well to have good ROI. So if that land that you bought has good ROI, then the commercial real estate on that land will also have good ROI as well. But that can also change as well, since I'm deviating off it, might as well say it, is now that you have a piece of land and a commercial real estate on that piece of land, will there be any tenants or will there be as much business flow? Considering that when you have inflationary pressure and interest rate pressures as well, and people being dissuaded and wanting to buy or invest in these businesses due to having to make changes in their expenses, do you feel as though that they would make as much money as they were making prior to the change of these interest rate, prior to the implementation of these interest rate hikes as well, in addition to the supply constraints and the changes in how they have to reallocate their money to actually fight inflation? So what I mean to say is, despite the fact that you'll have a land that'll make ROI, will the commercial real estate on that piece of land have equal or greater ROI, or will it lose an ROI as the real estate starts to lose in traction? Because of course, I'm sure you're aware, the real estate sector right now is primarily a seller's based market, and a lot of people are selling right now at a really good bid price. Of course, they're selling above property value, which is phenomenal. I mean, same thing for used cars, same principle applies. But anyways, when that starts to change, and it will change, because when you have people selling and you have these rising APRs for mortgage, well, you're not going to want to try to buy more property as a personally, because why would you want to buy another piece of property or a house when the APR for what you have right now is something that you can handle, whereas a bank can set a local or central bank can set the APR for the loan or the mortgage that you're taking out. But that's before you even factor in like credit worthiness, monthly income, several other parameters. But all that crap aside, like it really depends on the domino effect of things and how investors will play this out. So I don't know, but I think that all of real estate will be impacted as far as value.
What about virtual real estate?
Does that satisfy your question? I don't.
What about virtual real estate?
You're on mute, by the way, Luis.
I'm not muted.
How are you on mute on Wisdom? You're on mute all around, dude.
I don't think I'm muted.
I just see your lips moving, dude. Yep. I don't want to say anything else because I don't know if the audience on here can hear me versus the audience on Wisdom. Wait, I don't even think the audience on Wisdom can hear me. Can they?
Can you hear me now?
Wait, let me see.
Can you hear me? Can you hear me?
Can if there's anyone in the room here, can anybody send like an applause or anything if you guys can hear me? No response. Okay. All right.
Can you hear me? Let's see. Mick said he can hear both of us. Okay. Well, Mick can hear both of us. Let me try this. Let me leave. Go back in.
All right, so we are going to figure what the heck is going on here.
Can you hear me now, Malcolm? Can you hear me? Can you hear me? Can you hear me?
I believe there's some kind of audio interference of some sort, like it's interrupting both the laptop. Like I can't hear you, and then I can't hear you there. So, all right. Let's see here.
All right. Well, for whatever reason, Malcolm cannot hear me, but the audience can hear me. I'm not sure what's going on there. Audience can also hear Malcolm. So my question to Malcolm was virtual real estate. Will virtual real estate be impacted by what he's saying? Does he believe that? Let's see. I will ask him this right here through text. Will virtual real estate, will virtual real, all right. So that's not even working, but that's okay. So I think what I'll do here is I will. You can hear me now?
Yeah, I can hear you now. I don't know what that was happening.
All right, cool. So my question was, what about virtual real estate? You said all of real estate is going to be affected by this, but what about virtual real estate?
Were you saying anything prior to that as well? I'm just curious because I saw like your lips moving, your body moving. It seemed like you were talking, but I couldn't hear you necessarily. I don't know if you were asking any other questions, but it's besides the point. What about virtual real estate? Is that what you
said
asked?
that commercial. You said all of real estate will be affected by this. What about virtual real estate?
I feel like with virtual real estate, I think that would be an opportunity for people that are currently invested in actual tangible real estate to tackle because despite it's not
But
as
will it
popular.
be affected by it? That's my question. Like, is it
Well,
going
yeah,
to be affected?
but in a good way. I personally believe it'll be affected in a good way because as property, obviously, it fluctuates in value. You know, it's like if you like common sense is telling me, and I will inevitably do that. With the potential that virtual real estate has right now, I mean, I'd be stupid not to buy a piece of virtual real estate, but it's so freaking expensive. I'm reluctant on even getting involved in it right now, but I feel like I would miss the bus if I don't. So, still one of many financial decisions I am making on my own behalf.
When
As
you
far
say
as
it's so expensive, how is the pricing
my brother looked at a
to
piece of.
real real estate?
I'm sorry, what?
I said you said that it's really expensive. So how does it compare to a piece of real estate in the real world? Houses go for free. In median, a house is $350,000. What's the average price of a virtual plot of land?
Oh, I don't know the average price of a virtual plot of land. I've seen a price of a virtual plot of land, and at the time it was about $30,000 at one point. And that brother showed me it because he was looking into buying it. And I would equate the current difference right now. Well, my personal view on the current difference between virtual real estate and tangible real estate is the ROI. I mean, there's yield, and obviously you will make yield in both fields, but you will make consistent ROI at least until people get onto the train of investing into virtual real estate, and that real estate starts bringing in more ROI, return on investment, to be specific. I mean, I spoke with and one of the top mentors on this platform on Wisdom. His name is Daniel F. Harb. Him and I had a very stimulating discussion about real estate, and he's actually invested. He's very heavily invested in real estate, and that's actually what he's been doing for about, I think, 30 or something years. And he had mentioned a few things that he's done as far as flipping properties and flipping land. It's amazing. I mean, it's amazing how you can turn $4,000 to $5,000 into $50,000 in a matter of perhaps a year or even 2 years. I mean, that's good ROI. I don't think anyone would get that kind of ROI as of right now if they were to invest into virtual real estate. But given the nature of our economy and where we're headed, especially as you have the metaverse becoming more prominently spoken about, and of course, obviously it's here and it's here. So I just see that there's definitely a lot of potential for virtual real estate, and that's the only thing that I would to distinguish between the two as of right now. But you got to remind, I'm speaking in present term as opposed to future tense. But just to get to what I was going to finish here, and then I will hand it off to you for you to talk about your topics here, because I know I've held the stage a majority of this time. I think we're going on about hour or two, 2 hours maybe. Longest show we've done.
I'm not going to go into anything that I had to cover. We're just going to end it once you're done.
Okay, that's fine. So another form. So with car loans, when you take out a car loan, that loan has a fixed interest rate pegged to Treasury yields. Once again, those Treasury yields, those Treasury notes, a lot of the things that we buy are based on the benchmark of the Treasury note. And that's one thing that a lot of these things draw in similarity. So this means that the rise in interest rates shouldn't bring any surprise for those who already have fixed interest rates from an existing car loan. Because it's a fixed interest rate. Like for what I have a fixed interest rate on the SCRA that I receive from being in the military. 6% guaranteed for like anything that I purchase as far as loans go. So like if I were to get go and buy a house or a mortgage, I would have at the expense of the government and the SCRA, Service Members Relief, to get that fixed interest rate. Now in today's society, 6% interest rate is not good. You want to get anything below anything below 4%. 4%, it's not bad. I mean, you're paying more towards the asset than the principal. Anyways, but yeah, I would highly recommend speaking with your institution or perhaps the lender into getting a fixed interest rate. So with that being said, for those looking to buy a new car, this is when it gets a little interesting. It's essential to make sure that you do the math on financing a vehicle, because you will have these credit checks that go through different institutions, and because these banks will have the flexibility, because of these interest rate hikes, to rise interest rates on these assets that you're loaning or that you're borrowing from these lenders. Well, that means that I personally feel as though that credit worthiness is probably not even going to be one of the things that they factor in anymore. But I mean, unless you have anything above like a 750, but I personally feel as though anyone that has anything lower than a 650 could end up being screwed as far as APR goes when trying to go for a loan, especially as these interest rates rise. Like, it's only going to make it harder for people that don't have a good credit score. That's my 2 cents on that. But in addition, just keep in mind that individual car dealers and lenders change different amounts for your specific new car loan. So they also play a role into the fluctuation of the APR, because part of your car payments, if you do establish a loan through a lender or through a dealership, because you can establish for the dealership, which in this case would result in a lease, and basically the dealership, it's like a chain. It's like the dealership finances through other banks, and those banks finance through other banks, and those banks finance through central banks, and those central banks finance through the Federal Reserve, and the Federal Reserve finances through the people that are already there. So it's like it's interesting, isn't it? So with that being said, just be wary of how you can do your math when it comes to acquiring a new loan or any form of kind of debt that you could be taking on, as we are now entering a culture of rising interest rates. And one of the other pieces of advice as far as what rising interest rate means for you, and this one's important, and I touched on this a lot outside of this, is credit cards. If you have any form of credit card debt, existing credit card debt, I would definitely encourage you, and I'm not a financial advisor, but to try to satisfy that or rectify it or dispute it or do anything that you can to eradicate it. Simply because these institutions that bank through, once again, other banks that bank with other banks are also establishing an interest rate, or an APR, annual percentage rate. They're establishing that for credit cards. The highest APR that I've seen for a credit card so far, and this is ridiculous, I haven't seen this in forever. Well, I've never seen this actually. It was a 29.99% APR for a credit card, as an unsecured credit card, to say the least. Now, unsecured credit cards are more volatile than secured credit cards, because obviously, it's your money that you're putting into the credit card, saying that I want to put this money in here and use it for my own benefit. But it's really interesting. secured credit cards are becoming more prominent in today's society. And it's really fascinating to see the innovations in credit, because secured is obviously you set your balance on what it is that you'd like to take out from your own money that you're setting for yourself. It's really interesting. But with that being said, if you have any form of credit card debt, then now is time to start trying to pay it down before the institution that you're borrowing through raises the APR on that particular credit card. And with APR, it's essential to know that you don't want to deal with APR if you have an existing and ongoing balance, unless, well, you wouldn't have to deal on paying on interest if you satisfy the balance each and every single month. So APR wouldn't really, you really wouldn't care about APR if you're, if you don't have any debt to that bank. So that applies to people that have loans out or existing statements. So what this means is that if you have any kind of lingering balance on your monthly statement, then you will be paying a lot more on interest than what you once normally used to pay if you were still paying on that. So there's going to be more interest tagged on to the balance, is what I mean to say. Now that could lead into it becoming a lot more difficult to try to pay that balance down, or as I mentioned, that unsecured debt as well, that debt that you take out from a third-party institution, it could become increasingly difficult to try to satisfy that unsecured debt. I've never tried it before, but if you looked into a debt collection agency or debt relief agency, maybe you could see what they would work with you. But I feel like it's just like a rabbit hole of nonsense, because all debt relief agencies is they're regulatory institutions that basically take on all the debt that you have and combine it into one account and just give you a fixed rate in which you would pay off that debt. And it does help because it will reduce the overall balance that you owe. So let's say you're in $10,000 worth of debt. If you go to a debt relief agency or an institution, they will take off at least 40% of the complete balance of that $10,000 that you are in debt, and then you will be paying on a fixed rate and interest on that. Well, it varies. It can be a fixed rate, or it doesn't have to be a fixed rate, but I guess it depends on the institution that you're doing it through. There's so many parameters, but just be wary of where you're researching as far as where you're borrowing your money from. And if you can negotiate with that lender, please try to negotiate with them. Do it for the better interest of yourself, please. And with that being said, and this is a quote, it's an excellent time to pay down credit card debt, but this means that it's only more costly to hold credit card debt. And this is from Kristen Uhrig, a financial planner and founder of Brooklyn Plans. Furthermore, according to the Wallet Hub's March report of more than 1,500 credit card offers, the annual percentage rate for those with good credit was 18.98%. That's high. That's high for good credit. For good credit, that's high for good credit. I can only imagine what it looks like for bad credit. Well, I can't, because I have bad credit, but I'm working on it. It's fine. It's fine. Luckily, I don't have any debt. Anyways, an increase in interest rates can sometimes affect the credit card annual percentage rate, or APR. The Wall Street Journal found that some credit card rates are going up regardless of interest rates. As generous rewards and points programs become more popular, these perks are costing banks more, leading many to raise rates to cover such costs. Isn't that fascinating? They're like, well, if they're going to try to make money off of the money that we're lending them, well, we better make money off of them making money from making money off of us. It's kind of interesting. I guess that falls under that effect that you mentioned. I'm going to stop bothering you about that. So with that being said, just be careful with the debts that you take out, or don't take any out at all. It's as simple as that. Just be prepared to pay it back at a later date. If you aren't prepared to pay it back at a later date, or if you aren't prepared to take out debt that you can't handle, unless it's under extenuating circumstances, then please don't do that to yourself in this climate. And lastly, and definitely not least, bank accounts is one of the things that you will definitely be impacted on, as we briefly touched on the beginning of this episode, and we'll close with this. Right now, banks don't have any incentive in rising interest on savings account, which means that the money you're keeping in a savings account, even if it is a savings account, is losing value and is not hedging against inflation. During the pandemic, Americans have been, I guess, harnessing money or just hoarding money at the expense of trying to prevent any or mitigate any loss. And with that being the fact, and this is just a quote, the traditional view is that rising interest rates help savers, but most people who are savvy are in a broader range of assets, said Caroline Faux-Lin, professor of economics at Amoy University. Very interesting. I struggled writing, tapping her name in when I wrote this. She also actually stated that for your average person who just has their money in a savings account, you are making nothing. This is exactly what she said. You're not making anything, as previously mentioned earlier. And if you think about it, interest rates offered on savings accounts and many certificates of deposits often move with federal funds, with the federal funds rate. And according to the FDIC, the average annual percentage yield on a 1-year certificate of deposit, and we briefly touched on that, the average is 0.14. And you said the high was, I believe, what, 0.84 at 0.86%? Yeah. Goldman Sachs Group, Marcus's account is now offering a 0.50%. I guess that's good compared to certificate deposits. Online banks like Ally are also offering 0.50% for their high yield savings products. People were looking for alternative investments and yield, which implies more risk. So, as interest rates go up, certificates of deposits will go up. But if interest rates go down, certificates of deposits will go down. But there is still yield to be made off of it. So that once again equates to what we spoke about earlier with the yield. You lose yield if interest rates begin to dwindle, but you gain yield if interest rates rise. However, with inflationary data that you have to factor in, are you really making more than you're losing? Or are you losing more than you're making as well? It's a really interesting question to ask. So with that being said, the important message here is to know what you are doing with your money as interest rates rise and how you can find an alternate way to hedge against inflationary pressure. Keep in mind that this is one of many rate hikes that will occur this year, as the Federal Reserve plans to implement, at least from what I'm reading, but I can only assume 10. That's quite a lot because there's a lot of possibility that they could adjust it even more aggressively. They can honestly become more aggressive with these rate hikes, and before you see it, you start seeing it wouldn't surprise me if you were to see like a 40% APR on a credit card. Yikes. But with that being said, that basically concludes the four ways in which how interest rates will affect you. And once again, just briefly, I'll touch on the bullet points that I had because I know I said quite a lot. So rising interest rates, what they mean for you is that interest rates on future and existing mortgages will rise. Interest rates on new car loans will rise. The APR, annual percentage yield, will increase on future and existing credit cards, or any form of unsecured debt will also increase as well. And interest rate in bank accounts will remain unchanged, which means the money that you're saving in a savings account is losing value. Thus, you're not making money from your savings account. I remember when I made my first savings account, I was like, oh my God, I made 1 cent. That's amazing. I felt on top of the world until I learned that I wasn't really making any money. I was actually losing it. But you live and you learn, right? That's what life is, right? So that basically is what is concluded in a lump sum of everything that we briefly touched on today. And I do want to conclude this particular topic here with saying that I am not a financial advisor. I am an average human being like you, and I'm learning about the market each and every single day, as anyone that is involved in the market is as well. So the information that I provided here is to be used as a potential reference point, but to not be taken into fruition. And if you wish to do so, just understand the risks associated with that as well. So that's my disclosure. Anything to add, Louise?
No, I'm good, man. So everybody, thanks for showing up. Thank you, guys. Please hit the like, share, subscribe, and we will see you next Friday. Much love. Peace.
Peace.